It's the start of a new year, but the same old rising interest rates will continue to be a hot topic for Americans. According to Bankrate.com's interest rate forecast for 2023, the hike may be more severe than expected. Bankrate sees rates climbing to 5.5% during the first half of 2023. That's higher than the Fed's current forecast. Joining us now for more is Greg McBride, Bankrate.com's chief financial analyst. Good to see you, sir. So how do we break that down? Are we talking about a 50 and a 25 and a pause, or how do you see it? And why do you think the Fed has to bring rates up to 5.5?
The economy has certainly been more resilient than I think a lot of people expected, considering we have 7 rate hikes in the rearview mirror. And so I think that's going to give the Fed a little bit of leeway or compel them to continue to raise rates in the first half of this year. And how that breaks down, I think they've got certainly some options. And I think that's going to depend on what we see on the economic data, particularly employment and inflation. But whether they raise rates at another 0.5 percentage point and then go quarter point increments, skipping a meeting along the way, or if they go quarter point all along the way, a lot of that's going to be dictated by the data. But I've got them raising interest rates another full percentage point, but doing so in the first half of the year and then moving to the sidelines. What I don't have in the forecast is them reversing course and starting to cut rates in 2023. Once they're done, I see them plateauing and holding steady for a while.
So, Greg, all this will add up possibly to more pain for the economy, more pain for consumers. So let's talk about what it means from a consumer angle. Starting with credit cards here, rates reaching record highs we saw in 2022. When you take into account a hawkish Fed, what does that mean for credit card holders in the new year?
This is one where if the Fed is going to raise rates another 100 basis points, 1 full percentage point, your credit card rate's going to go up 1 full percentage point. So this is really important. If you're carrying a balance, now's the time to take some action. Grab one of those low rate balance transfer offers, turbocharge your debt repayment efforts, because the most expensive debt you have is going to continue to get more expensive, and it's going to move in lockstep with whatever the Fed is doing.
And what about auto rates? What does the Fed action have to do with auto rates? How will it change it? And how will that impact the sector as a whole?
I do see some more upward influence on rates here. I mean, there's not a one-for-one correlation with the Fed. I think on average, I've got new car rates will be up about 0.75 percentage point this year. Used car rates up closer to a full percentage point on average. The key thing for borrowers here, make sure your credit is in good shape and shop around. We do see a wide variety of terms, and your credit rating is going to become even more important, particularly if we start to see the economy weaken. That's going to be the difference between paying 7% or paying a rate that could be double that. As for the impact that's going to have on the sector, it doesn't help, but it's not the headwind I think that a lot of people think it might be, in the sense that, like what we've seen in housing. Auto loan rates, another percentage point of rate hikes, makes a difference of about $25 a month on the payment, but it's $25 on what's already an $800 payment. So is that really going to, is anybody going to downsize from the SUV to the compact based on rising rates? Probably not.
Greg, you mentioned housing, so let's talk about it, because mortgage rates was a huge story, especially in the second half of 2022 when we saw those rates rise above 7%. Where do you think rates are headed this year?
I think the first half of the year is going to be pretty choppy. We're in the high 6s right now. So I think between 6.5 and 7 here in the first half of the year, at least until the Fed moves to the sidelines. Once we get to the second half of the year, if the Fed's on the sidelines and we're starting to see more evidence of that economic slowdown or the recession that 2 out of 3 economists is forecasting, that's when we'll see a more sustained slide in mortgage rates. But it's, temper your expectations. I have mortgage rates fall into the low 5s by the end of the year, 30-year fixed at 5.25%. Now, that's a big improvement over where we are now, but that would still leave rates 2 percentage points higher than they were this time a year ago.
Right, and do you expect them to stay at that level around 5.25 into 24? And is that enough to stimulate the housing market, or will it stay frozen?
I think a lot of that's really going to depend more on the health of the economy than it will on the level of mortgage rates. Some of the lowest mortgage rates we've ever seen historically have been in periods where the economy was on the ropes and the housing market was comatose. So when the economy's bad and people are worried about their job, they don't buy houses. So if we have economic weakness or a recession that's really driving those lower rates, I don't think the low rates are going to pull a lot of people off the sidelines. I think when you get some stabilization in the economy and there's a feeling that things are on the rebound, that's when people will come off the sidelines and look to buy, even if rates have ticked up a bit at that point.
Bankrate.com's Greg McBride. Good to see you, man. Thank you.